Most people think private equity is about money. The truth? It's about knowing exactly how to turn $1 million into 10 when everyone else sees nothing but risk. And today, my guest is going to show you how. All this and more coming right now. Here we go. Neel, welcome to the show, man.
Thanks so much, Ryan. Yeah, pleasure to be here.
Yeah, it's good to have you, brother. So let's jump right into it. You've done a lot. You've built NB Group for, I believe, 8 years now. How do people who want to get into private equity or just do deals, running funds or syndications, there's a lot going on, but there's a lot of common threads. And one of those is winning. So I'm curious, from your perspective, how would you recommend people get some early points on the board and start winning in private equity and just running deals in general?
Yeah, sure. Happy to talk about that. And, really like the community you've built here, emerging managers, asset managers, people who may want to get into private equity. So happy to share some lessons and be a guide as much as I can. But to answer your question, how to win, I think one of the things I've learned is saying I developed is be focused and flexible. What does that mean? I think it benefits you to have focus in one way. Could be on a sector, could be on a theme that cuts across sectors, could be on a region of the country or the world that you want to invest in, or it could be in the types of companies, only businesses that are, founder owned or something even more specific. By doing that, it enables you to get really educated on that theme, sector, region you're trying to invest in, get to know lots of people who are connected in that ecosystem and get your name out. So I think being focused is the first part. At the same time, you need to be flexible to get your first deal, your second deal done. Maybe the business is a little bit smaller than your ideal. Maybe the economics you're getting from your LPs aren't, where you want it to be a few years from now. Maybe the deal structure, you want to do majority deals, but this was going to be a minority. There's lots of different ways to do deals. What's important is get your first deal or two done, be flexible in how you get there. And, that's something we have to do when we got started as well. So be focused and flexible.
Love it. That's great advice, man. So being focused and flexible. What else? What else have you seen from your experience? You've done a lot, man, on just how people can put some early points on the board.
You want a lot of deals to be home runs, right? That's what we're in the business for. At least that's what I'm in the business for. But every deal is not going to be a home run. And, the first one you do, you also don't want it to go very badly. So I think you need that kind of balance of risk and rewarding first one. You want to be highly confident that not going to lose money. You have a really, really strong chance of getting 2 times your money back or whatever it is. You also still have the ability to get 4 or 5 times, but you want it to be like a tight band around the outcome, I would say, or to be at high confidence in that, because your first deal going really badly is just as notable as your first deal going really well.
Brilliant. And how would you, on this show, we talk about reputation, relationships, and results are the most valuable assets in your possession. I'd be curious to know your opinion on how the professional relationships, how does that affect you, putting points on the board, getting started in this industry? I'd love to know your perspective on that.
So I think relationships are critical. Private equity a lot of it is a relationship game. And I think the most important relationship is your relationship with the seller, the person you're buying the business from. Our model is to partner with those owners, those founders, typically of the business, have them retain a good chunk of equity and continue to be involved in the business. And so that relationship is critical for 5 years, 6, 7 years, however long you're going to own that asset. But it's also important to get the deals right, and that's maybe more about what I mean. Why relationships are really important. There's lots of different sources of capital out there. There's lots of private equity firms. There's lots of different other sources of capital. They could take on a loan if they wanted to in some situation. So establishing that relationship with the seller, making it clear why you're going to really be the right owner of this business going forward. The things you care about are the things that they care about, that their employees care about. You really need to demonstrate why you're the right owner for the business, but they have lots of options.
Yeah, brilliant. One of the things I know in this industry in alternative assets, a lot of people like to hire consultants or people with investment banking experience. And when it's at the higher level, I can tell you the reason why those people get hired is not because they necessarily possess the one and only skill. People who get hired have demonstrated that they have the right relationships and they can build those and bring those to the front of the line. I even recall a guy, he was on the show earlier, a VC, his name was Tomas Tungus, and he launched his VC firm after 17 years in the industry, and he raised over like $500 million. How did he do that? He'll be the first to tell you, relationships. He was in the industry and he nurtured those things and took good care. And so when it was his turn to kind of spread his wings, He did it beautifully. So I absolutely love that. Relationships are absolutely critical. Now, the other thing that I'm curious about is, sure, great, get good points on the board, but how do you not lose in this industry? So there's downside risks, whether you're a beginner or a seasoned deal maker in this industry. I would say not losing is also part of that. What have you found to be helpful when trying to avoid some of the downside risks?
Yeah. So there are ways you can structure deals so that you are protected against that. One is, using specific financial instruments like preferred equity, where, your money gets out first. Maybe you have a little bit of a paid in kind dividend on top of that. That's something that when we, we're paying, relatively healthy multiples for good businesses. And, as a trade-off, sometimes we're saying, okay, well, we're going to give you this nice upfront value. We want a little bit of protection through a convertible preferred structure. So getting to sort of the financial mechanics, that's one way to protect your downside. Having a balanced risk reward trade-off, like I talked about a few moments ago, is another one. Also look for industries that are economically resilient. We're looking right now at education. Parents are always going to highly value education. It's, for many people, non-discretionary, and that makes us feel good about the downside relative to some more discretionary consumer investment. So those are a few ways to think about, where you invest and how you invest to protect your downside of the outcome. Another thing I think about is how to make sure you don't lose that deal when you have it, line of sight to getting it signed up. And I think one thing I learned after doing this for a while is before you sign the papers around a letter of intent, here's the deal I'm going to do. Really be thoughtful about every charge you're putting in there, how various constituents are going to think about it. Lenders, equity sources, if you're going to equity sources, how the seller's going to react if different things happen. How this is going to translate into legal docs. You really have to be thorough and thoughtful when you're negotiating terms up front, because a good way to lose a deal is to retrade on that deal. Put some aspect of the deal out there that someone else who needs to agree is not going to agree to. So I think that's a lesson learned that I would put out there for people.
Yeah, brilliant. So really making sure that you think it through from first principles to second order effects, third order effects. Make sure that you really understand who is going to be affected, what's going to be affected, how will that translate to our cap stack, our partners, everything on the deal. How do you feel that, let's say, someone doing their first deal, because I know a lot of people, I've heard it, they're like, well, if first deal, I'm going to invest in, building robots in outer space, these like huge moonshots. Do people really go for the Hail Mary and try to win, or do they take a more balanced approach? What have you found and to cover that downside?
Well, I think it's prudent to have a balanced outcome set that you feel confident about in your first deal. But I'd also say, you got to get deals done, and you got to get that first deal done to gain credibility. So, I would say don't be overly picky. If it's a good deal, you think you can make money, it aligns with what you're trying to do, you believe in the owner or the team. Don't wait for the perfect thing. Take the deal that you think is good, that you can get done.
Got it. Yeah. And just make sure that, a good deal is a good deal. Like I always say, you don't want to catch a fallen knife either, where people are just hawking. You talked about the retrade. So there's a lot of things that go into that for sure. Now I'm curious, I'd love to just shift gears a little bit. Curious what you're seeing out there in the market. From your vantage point at NB Group, what's exciting you? Maybe what's some things that are concerning you, and everything in between. What are you seeing out there right now?
So you mentioned up front, we invest in two areas. One is multi-location services, which is business model we invest in across categories and industries. The other is healthcare. We're really excited about multi-location services right now. I think there's so much that falls under that umbrella that has tons of opportunity for growth right now. When I first started, we used to call this retail and consumer, which is the lingo that my old firm had, and then it's kind of like the traditional way to talk about this sector. We call it multi-location services because I think it's a better way to describe it. What this means is businesses that offer a service to businesses or consumers that can expand by opening new locations or moving into new geographies, otherwise extending their footprint. And when you think about that, there's so much that falls into that, but there's also so many similarities in that once you invest in a gym business like we have, you may think the landscaping business is very different, but actually there's a lot of similarities in how you have to manage different regions, and how you think about unit economics, customers or locations and everything. So there's a lot of, interesting areas of that that are still underinvested in. The US is a massive market, which is part of the thesis here, right? Once you have a model and offering a service that works, you can just duplicate that in new cities, new states, new regions, and just grow into this massive market that we're fortunate to have here in the US. So we're really excited about a number of areas with that.
Brilliant. And where do you see, so that's what you're seeing now. That's what's exciting you right now. You see those opportunities. Now looking forward, obviously this is what we do, pro forma in the form of spoken word, but looking forward, where do you see the value? Where do you think the smart money is going? And let's unpack that a little bit.
I think there's an emerging, kind of barbell effect happening in the industry. You've got large, the bulge bracket, previously private equity firms, but now really asset managers who are becoming bigger and bigger, gathering up assets, developing new strategies. It could be, now they've got a large cap fund and a mid cap fund and a small cap fund and a micro fund, and they have private credit and private equity and real estate and special situation, but it's like every year or every 6 months, there's a new strategy they're deploying. And they're able to do that because they have really plentiful access to capital. They demonstrated good team, strong capabilities. And that's one strategy. I think there is another strategy around moving down market to businesses that command lower multiples, that have more room for growth, and you've got more of an ability to really get an outsized return, 4, 5, 6 times your money or more, which is where we invest. I think that middle group, the middle market fund with, $500 million to $2 billion under management or something like that, who's typically achieved, 2 times returns. It's getting harder for those firms to raise, to just keep doing that and raise funds or raise bigger funds because the capital is being pulled in 2 different directions. So that's where I see the market moving. We play at that lower end of the market, higher returns. And I also see more capital moving into kind of deal by deal model rather than a fund where you've got more discretion about what you're investing in. Your money's not as locked up, and there's more alignment with the sponsor as well.
Brilliant. Okay. And as we round third base, what would you say would be maybe some competitive advantages that you can share with people? Just some leave behind. You've been in the game for a long time. You've held amazing roles. You're running your own firm. What would you say would be some helpful competitive advantages you can leave with our fans?
If you're thinking about starting your own private equity firm, this process I went through, 8, 9 years ago, a couple things that I would point to. One, consider a partnership. It is, I started on my own, spent several months, kicking around deals by myself and, not having anyone to talk to, not having that sounding board to make sure my thesis was sound, doing everything. I found it challenging. I found it, lonely. I found it, hard to get necessarily completely certain about everything I was doing. So brought on a partner who's, a good friend of mine from a long time ago and had done similar things. And I think that's one thing that allowed me to really stay motivated and, has led to our success, just having, that partnership. So you are trading off some economics, doing something on your own and keeping all that for yourself. Like it's more economically rewarding in theory. But you have to persevere through that and get all those deals done and be able to do as many deals. I think it's well worth the trade-off. So that's one thing. The other thing is, I mentioned a few moments ago, I do see capital moving more towards deal by deal funding rather than, only having, only investing in funds. We follow the deal by deal model. I think it's a really compelling way to invest for, yourself as a sponsor and also for LPs. And it can be done without a fund. Like you can do really good deals. You can build a brand. You can build a reputation, and it can be really, really economically rewarding. So consider, whether raising a fund is the right thing or you want to explore just doing things on a deal by deal basis. So those are a couple things both going to.
Awesome. And I like to ask this question, but is there a book that you just can't recommend enough?
Yeah, good question. I did set a goal this year to read at least 12 books. I'm well on, I think I'm basically that, probably beat it. So I have been consuming a lot. One book that stayed with me is called Why We Sleep. Really interesting book that goes into why sleep is so important, how to be better at it, and just how to maximize the benefits that you can get from it. It's not about private equity at all, but I think it's about being the best you can be, which I think sleep provides a foundation for. Wellness, I think, is really an important topic for me and a lot of people. And this book was, just really well written and thorough, and has really made, a change in how I live my life. So it's one I would recommend.
Awesome. I love it. Yeah. Sleep is important. It matters. All warriors need sleep. My son gave me a talking to last night when he realized I was staying up till 1 in the morning every night. He just figured that out. He's 9. He's like, Dad, all warriors need their sleep. I was like, oh, bless your heart. Thank you. But I'm good. But it's no less true. So before we wrap things up, is there any ways people can reach out to you if they want to learn more, enter your world, anything at all?
Yeah, for sure. You could find out more about us at our website, nbgroup.us. You can find me on LinkedIn, Neel Bhargava. Reach out to me, Neel at nbgroup.us. But would love to talk to anyone who wants to talk.
Awesome. So just to wrap things up, consider partnerships just to help you cover more ground, to air out your mind. It's really good to have a little bit of that back and forth. Second one is maybe launching a fund isn't the best idea, right? Obviously, lawyers and accountants you should talk to them and make sure it's right for you. But sometimes launching a fund is not the best deal structure, and it might actually be cumbersome into what you're trying to accomplish. And finally, great advice. Sleep is the ultimate biohack. I think rise and grind is dead. Instead, why don't we try to rise and prime? You do these things and you too will be well on your way in your pursuit of making billions.